happen in this fiscal year. We delivered industry-leading growth for our services business. We grew at 15.8% year-on-year in constant currency. And HCL Software, our products and platform business, grew 1.8%. That's excluding the divestments that we made. 1.8% in constant currency on a year-on-year basis. Our operating margins came in at 18.2%. We guided 18 to 18.5. We came pretty much in the midpoint of that guided range. In terms of segmental performance, our IT and business services grew 15.6% year on year. We started in the first quarter at 17% and significantly improved to 18. We started at much higher growth rates. Some growth rates have come off. So the overall growth was about 15.6%. Our engineering and R&D services business grew 16.8%. Again, a strong performance. HCL Software, as I said, grew 1.8%. And HCL Software business continues to exceed expectations with an 8.2% year-on-year growth, excluding divestitures that we made, even during a traditionally weak quarter in the constant currency terms. We've crossed a very, very important milestone in our HCL Software business. We clocked in $1 billion of ARR, which is annual recurring revenue. That is one of the key measurements for software companies. So HCL Software is now $1 billion plus ARR revenue, a very profitable revenue stream. While there is a lot of dynamics externally, we believe we have some comfort in our ability to navigate this dynamic market because of the mix of capabilities and expertise that we have and the service offerings that we have. These offerings are very relevant when customers want to invest a lot in transformation, as well as when customers want to cut down on transformation and optimize their run the business spend. I think we have a very balanced portfolio which addresses all seasons of the economy. That's how I would want to call it. In terms of geographies, Europe grew the highest, 20.6% year-on-year in constant currency. Americas grew 14.4%, and rest of the world grew about 11%. Our top performing verticals for the year were tech at 22.5, telecom at 22.4, manufacturing at 18.3, all year-on-year on constant currency. We've had some very good client additions. We added $300 million customers. We have $1,900 million customers as on date. We have 46 clients in the $50 million range, which is again an increase of 3 from the last year. Overall, our $1 million category is now at 939 clients, which is a 57 clients added during the last financial year. These two metrics, the clients growing and the $1 million clients growing, is again very reflective of the large clients growing is reflective of our mining capability, where our propositions are relevant and customers are willing to spend more with us and our services are very relevant. And the $1 million client growth is a lot of good high growth companies or big companies where we have made initial entry and they offer a lot of potential to grow. From a bookings perspective, we booked about $2.08 billion of net new deals in the last quarter. In FY23, our bookings grew 4.3% on ACV and 6.6% on TCV on year-on-year basis. Last quarter, we signed 13 large deals across products and services. Couple of deals I want to highlight is a global top 100 banking and financial services company in our new frontier markets. A new client, he selected HCL Tech to transform its customer relationship channels. HCL Tech will implement a new modern Salesforce CRM and omnichannel solution to enable the bank to deliver hyper-personalization to its customers. This is the largest win for this quarter and a big one as we look beyond our core geographies. It's also a deal during a period when financial services globally is in a state of flux. We won a few other large deals both in US and Europe in this sector, which is a sign of our propositions in this market. A Fortune 500 company, a long-term client, expanded their partnership with HCL Tech to accelerate digital transformation across its operations through convergence of IT, which is information technology, and OT, which is the operations technology. HCL Tech has got a charter to modernize the OT environment to drive automation, enhance the safety of employees and productivity of equipment, leading to a more sustainable operations. Moving on from booking to pipelines, our pipeline continues to remain close to record high and is well distributed across geographies, segments, and service lines. Last 2 years, I think, has been a period of optimization. But as I look at our pipeline, I believe clients know the value of the technology and what it brings to the overall business. Still a little early days, but we do believe the tech spend is so vital for most of our clients, so they will continue to remain invested in their tech projects. In terms of people, Ram will cover some more details, but before I hand it over to Pratik, I want to cover a couple of more points. While there has been some stress and uncertainties in the system, be it booking delays or ramp-up delays, it's largely on the discretionary spend side. A lot of run-the-business spend, we don't see that much of stress. That gives us good confidence given our strength in both transformative spend and the operating spend. Amidst all the volatility, I want to call out a particular sector that all are validly concerned about, which is our financial services. We continue to see good opportunities. This quarter, we grew sequentially 6.9% in our financial services business. This is on the back of large deal wins, which we have been able to execute very well. We've transitioned on time, so the ramp-ups have been absolutely on dot to ensure that the large wins are converting into revenue. And also it's on the strength of both cloud and hybrid cloud adoption in the financial services sector, where we have a strong play, and that's what is helping, especially in insurance and capital markets in the financial services industry. Our recent wins in financial services is across all regions, Americas, Europe, and even our Latin American countries where we initiated presence in the last few years. I want to also highlight some accomplishments of HCL Tech in the last quarter on the ESG front. MSCI has rated HCL Tech as an ESG leader in the software and services industry and has upgraded our ESG rating from A to AA. HCL Tech has been included in the S&P Global Sustainability Yearbook 2023 as an industry mover for demonstrating sustainable business practices. We've also been included in Sustainalytics 2023 top-rated ESG companies list in the software and services segment in the Asia-Pac region. Now, coming to FY24 guidance, I believe FY24 will be a year of consolidation, both on the demand side and the supply side, because you've seen a lot of fluctuations in the demand over the last 18 months. Similarly, there has been a lot of fluctuations in the supply side, whether it is hiring, wages, all of that. I think FY24 will be a year of consolidation, and clients have accelerated their technology spend over the last many quarters. Since the beginning of the pandemic, it's time to review and consolidate with the most efficient and impactful technologies, and similarly consolidate with vendors who provide best-in-class services, who have the capability to scale globally, who are nimble, who value the relationship and partnership. It's those service providers who are going to win. Coming to guidance for FY24, we're forecasting a healthy revenue growth in the range of 6 to 8% and operating margins in the 18 to 19% range. With that, I'll request Pratik to give a little more details on our financials.
Thank you, CVK. I'll give you some more highlights, but The biggest highlight is, of course, the 1 lakh crore, right? On a quarterly basis, services revenue came in at 2.9 billion, which is up 0.6% in constant currency. Year on year, as CVK already mentioned, is 10.6. Within that, ITBS, IT and Business Services, came in at 1.6% sequentially, and 11.4 in year on year. ERS was the segment which showed a sequential decline, 3.8%, due to customers cutting back on some of the discretionary spending, leading to some ramp downs and paused delayed programs. But in year-on-year basis, they grew 7.3% in constant currency. Software reported a solid 7.9% in constant currency on a year-on-year basis. And if you exclude the divested business, it was actually at 8.2%. So that's a very healthy growth coming from that business. And therefore, the total revenue for HCL Tech in rupee terms came in at 26,606 crores, which is in rupee terms 17.7%, close to 18% increase year on year. For the quarter, EBITDA margin is 21.9% and EBIT at 18.1%, and net income came in at 14.9%. Which is up 1.3% on a year-on-year basis. We added headcount in the quarter, 3,674, about which Ram will sort of talk about more. Since this is the annual number also, so becomes a little bit of overflow of numbers, but let me quickly cover that off. So the total revenue came in at 101.456 crores, 1,01,456 crores, which is up 18.5% year on year in rupee terms. And even in constant currency, we are up 13.7%. Software delivered a growth of 1.8% in constant currency after excluding the divested business. Services grew at 15.8%, and EBITDA came in for the full year at 22.3%, EBIT at 18.2%, and profit after tax or net income at 14.6%. We continue to generate good cash conversion of the net profits. So last 12 months, operating cash flow came in at $2.23 billion, which is 121% of the net income. So we generated 21% more cash flow than the net income. And in free cash flow terms, which is after the capex, it is 110% of net income, which is 2 billion odd. Our balance sheet continues to strengthen. Gross cash is now at $2.8 billion and net cash at 2.5 plus. For the shareholders, we delivered earnings per share of close to 55 rupees, 54.79 to be precise, which is a 10% growth year on year. And the board has declared a dividend of rupees 18 per share for the quarter, which takes our full year dividend at to 48 rupees, because in the first 3 quarters we've declared 10 rupees per quarter each of the 3 quarters. So 48 rupees per share as a percentage of the EPS of 54.79 comes out to be 87.5%. We had promised a minimum of 75%, and we are happy to be beyond that for the second year running over that period of 5 years that we had made the commitment. The record date for the dividend is 28th April, and the payment date shall be 9th of May. With that, I'd like to hand over to Ram for the HR updates.
Thanks, Prateek. A very strong performance across all segments of our business is attributable to our people. Our people strength ended at 225,944. That's a net addition of 3,674 for this quarter. That included 4,480 freshers for this quarter. The total fresher addition for the year is 26,734. That's shy of the 30,000 aspirational number that we were working towards. But the good thing is we honored all the offers that we made, and we onboarded everybody without having to make any delays, and that's baked into our plan. Our plans are a quarterly rolling plan, so it allows us to moderate our intake in line with what the demand is. So we were able to conclude the year pretty much close to what we thought we would be in terms of fresher intake, more importantly, without having to defer or delay any of the onboarding. So that's good. Attrition has been a phenomenal story. We're ending the year with 19.5% attrition. The quarterly trend, last quarter I reported that we saw the attrition peak in the last quarter. If we look at the quarterly trend, last quarter I reported 210 BPS drop quarter on quarter. This quarter at 19.5, it's a 220 BPS drop quarter on quarter. So the quarterly trend on attrition is very encouraging. And I think in summary, the success that we have had in FY23, I think it's clearly attributable to our people strengths, not in just numbers, but also in terms of the skills and the investments that we have made through the year in our upskilling programs has all contributed to where we are today. And also the guidance for the next year is also on the back of what strengths we have built in FY23. So that's, with that, we'll probably open for questions.
Yeah. Yeah, I'll pass on the mic to identify yourself and your publication. I'll go first. Saurabh? Uncle?
Hi. Hi. Good to see you all. Good evening. My name is Sankalp. I work for Bloomberg News. I wanted to ask about your revenue mix. I mean, you've added clients in every category in $100 million, $50 million. But if I see the revenue mix, your business in the US has actually grown only by a few percentage points revenue. Again, in Europe, by just 2 percentage points. Rest of the world has actually declined. Then financial services, again, the revenues declined by a few percentage points. Public services down, retail down, telecom down. The growth in manufacturing is just 1 percentage point. Your commentary is overall positive. So I wanted to ask you, like, despite adding so many clients, the revenue hasn't really grown. The revenue mix I'm talking about. And then the guidance is a bit conservative. So can you give us a sense of where the slowdown is, especially in Europe and the US? And also, I mean, are clients delaying payments for projects? Are any projects stalled? Could you give us some color, please?
Can I just borrow the...
Sure.
Yeah. So if you look at our vertical growth, the quarter-on-quarter growth in financial services is 6.9%, right? And America's quarter-on-quarter growth is 1.8%, and year-on-year growth is 10%. And so I think these are good growth numbers. So I don't know what exactly you're referring to. In terms of the verticals, there are 3 verticals on a quarter-on-quarter basis have declined, but financial services has been strong, life sciences and healthcare has been strong, public services has been more flattish, retail CPG has grown 0.6. But if you take the constant currency year-on-year growth, it looks very, very strong. The tech and telecom are the two verticals where we are seeing softness. There are some discretionary spends which are being cut back, and that is really showing up in the decline in revenue in tech, which is sequentially declined 1.6%, but bigger impact in telecom, where you see a 5.6% decline. Now, manufacturing, also there is a decline, but it is primarily due to a one-time impact of a project coming to an end. That's why you'll see a decline of 3.5%. I hope this answers your question.
If I may just add, Sanket, you asked a slightly larger question as well. So look at it this way, all said and done, the growth in ITBS is 1.6% sequentially, right? Now, that is in keeping with the times, okay? And if you talk about the next year, we are guiding 6 to 8%, in services terms 6.5 to 8.5, right? Compared to the 13.7 we delivered this year. So yes, there is a change in the overall environment, which is factored into the numbers that are in front of you. I hope that answers your larger question that you had in your mind.
Hi, good evening. Abhimanyu, this side from CNBC TV 18. I have two questions. Firstly, can you explain for BFSI, very strong growth and very weak growth in telcos, and also any project cancellations and deferrals and the outlook on hiring?
So financial services, as I mentioned, has grown on the back of strong ramp up in the large deals that we won in the previous quarters. So we've had a phenomenal execution. All the execution has been on track. Our ramp ups have happened on time, and we've transitioned some large clients. We've also had some good programs in our financial services clients around cloud adoption and modernization. That's also contributed to the revenue. And if I just break financial services into banking, capital markets, and insurance, I think both capital markets and insurance is where we had the maximum growth. Telecom, as I called out even last quarter, we see cut in discretionary spend to be a little sharp. That's why you'll see a 5% plus decline. I think most of that has already happened. It's pretty much happened from the beginning of the quarter, or some follow-on impact of the ramp downs that happened in the last quarter. We are cautiously optimistic of what would further span out in these two segments, because there are some clients where there is concerted effort to be more efficient, and then we are getting some work coming our way. And there is other clients where they're a little more choosy about what discretionary projects to invest in. So this is the broad commentary on these two segments.
If we look at the EBIT margin, it has dropped 1.5% quarter on quarter basis. So what is is there any pressure from cost side, or what is the reason?
No, there is no pressure on cost side. I think the simple way to read, the correct way to read is the year on year. In our software business, we have a seasonality where the December quarter is a peak. So as per the seasonality, when you have a peak, then there is a drop in the next quarter, which happens to be this quarter. That's the only reason. Otherwise, if you look at it, last year, I think we were 17.9, we are at 18.1. I think the overall trajectory remains strong. It is just the seasonality in the software business.
Can I get one more question? Abhimanyu from CNBC TV 18. Yeah. The historical margin guidance, it used to be 18 to 20%, and you are guiding for margins of 18 to 19%. FY23 was 18.2%. Now, why is there no scope for big margin improvement despite declining supply side challenges?
See, I think we are exiting at a margin of 18.2%, and even if there is an improvement sequentially, I mean, even if you bake in a small improvement, the overall number would still be between 18 and 19. While our aspiration is to get to a 19 to 20%, this year, given all the variables that play into the cost structures and the ramp-ups and things like that, we believe will be between 18 and 19. Yeah.
Yeah. Hi, Ayanti Bera from Informist Media. I have one about your deal pipeline. It's at an all-time high, like you said. Can you tell us a bit about what kind of deals are these, and do you think the revenue conversion will be slower than the deals you had signed in the last 2-3 quarters?
Yeah, I think our overall deal pipeline is near all-time high, not exactly all-time high. And I think there is a big composition of large deals in the pipeline. If you look at the commentary 6 months ago, we would have said there is a good balanced mix of small, mid-sized and large deals. Now, given this economic environment, there is so much more focus on driving more efficiency, driving more automation, driving the best shoring options for our clients. So there's a lot more cost takeout deals in the pipeline across all the sectors. And the second theme is a lot of customers have already subscribed to significant cloud capacity with hyperscalers, and they all want to leverage that capacity. So there is a little more emphasis on faster migration to cloud so that they can consume the capacity that they have contracted. And there's, of course, continuing spend on data analytics and things like that. These are becoming very, very critical for a lot of big businesses. So while some discretionary spend is being cut down, on the core areas of transformation, I think it continues. Thank you.
And the revenue conversion, will that be slower in your?
So usually large deals, revenue conversion happens in 1 to 2 quarters mostly, depending on the exact nature of the deal. In some deals, revenue comes within 3 months, others maybe in the second quarter.
Hi, I'm Akanksha from Business Today. I wanted to understand your employee utilization and bench size. And could you tell us about the variable pay for this quarter and what are your hiring plans for the next financial year?
Okay. Let's start with the variable pay question. I think it's a very top of the mind question for everybody. We are not making any change to our variable pay plans. 85% of our workforce will be in a variable pay plan where the quarterly variable pay is just about 5%. So it's not a big percentage of employee compensation. And so far as the policy is concerned, the variable policy pay, there's no change in the policy per se. Right? We continue to follow the policy that we have followed. So there's no change in the policy. So far as hiring is concerned, if you see in the last 2 quarters, we have reported net additions in both quarters. I think last quarter we reported net addition of 2,945. This quarter again, we have reported net addition of 3,674. So there's not been any slowdown in terms of our net additions last year. So which means we have made conscious plans to build up our strengths for FY24. So the FY24 hiring plan will be moderated on the back of the net additions that we have done in the last 2 quarters. So that's important. We'll continue with our hiring plans for freshers. That will be incremental headcount. Our lateral hiring always has been a function of the projected growth and the attrition. Attrition, as I said, at 19.5% on a full year basis is a significant drop, 220 BPS drop from last quarter, which is again dropped from the previous quarter. The quarterly annualized run rate indicates that the attrition trend is going to further slow down. So which means our reliance on lateral hiring is going to be moderated basis that. I think you had a question about utilization. I don't think we are discussing utilization percentages specifically, but overall, that's the trend. Attrition down, capacity buildup has happened over the last 2 quarters, and that will get reflected in our hiring plans for next year. But fresher plans will continue.
Sankalp again. Ram, I wanted to ask you about hiring. So in terms of hiring, the number for this quarter is fewer than the last quarter, and the numbers of hiring per quarter, I'm talking about freshers specifically. So I wanted to ask you that, does this mean that in the year that's coming, this year, you might hire fewer freshers because there might not be so much demand and you might already have a bench? Also, now that the attrition has gone down, is it cheaper to get freshers from the market? I mean, that time from 2 years ago when there were freshers with multiple contracts in their hands and companies, some of your rivals were offering a career plan in employment contracts for the first time. Is that still happening? Can I ask a bunch of questions or would you like to answer? Because I want to ask 2-3 other questions as well.
Okay, let's first take the questions that you've asked, Sankalp. I'll first address the fresher thing. I think the way to look at the fresher numbers, I mentioned this last time as well, 1 quarter view will not give the right picture. We need to look at the trend for a full year basis, and you will always find that the JAS quarter will be the quarter when the fresher intake is always higher. So I think we reported 10,339 in JAS quarter. Now that's seasonal. It will always remain higher. On a full year basis, if you see, we have reported 26,734. Now that is an increase on the previous year, which is 22,859. Now, looking ahead into FY24, as I said, headcount addition is always a function of growth and attrition. Now, with the sharp decline in attrition, the overall hiring volumes will be moderated to reflect the attrition situation, which is actually a good situation to be in. Freshers for next year in absolute number terms will be around 15,000, which is in absolute number terms, it's going to be less than FY23. But the way to look at that number again is fresher addition as a percentage of gross hiring that we are going to do, which we expect to be higher next year. Fresher addition as a percentage of gross addition will tend to be higher. So which means our fresher intake is going to be at an accelerated pace. So that's the important point that we need to keep in mind. The second aspect of freshers coming in at a price point lower, I don't think we change the fresher compensation based on the market dynamic every now and then. And I'm sure you probably will know that our entry-level compensation at 4.25 lakhs is at the top quartile of what's offered in the industry, and that we have done in the last year, right? We changed last year. That will continue. I don't think we are going to moderate or reduce our fresher compensation because of the demand-supply situation. So we'll continue with our fresher compensation. We'll always aim to be at the top quartile so that we get the best talent that we can.
Thank you.
I think I addressed the questions.
Yeah.
I think those are 2 questions. Okay.
Yeah, thank you. So I wanted to ask CVK or Pratik, you can answer, whoever wants to. So the impact of Silicon Valley Bank and Credit Suisse, I mean, how does that play out in Europe and the US for y'all, considering financial services is already in a bit of a strain? And also, as things slow down a bit in certain sectors, this probably would be a good opportunity for acquisitions. And I know software services providers, standard answers, we're always on the lookout for opportunities. But if you could give us a little more than that, that'd be fantastic. And lastly, in terms of deals, the run side of the business may be under pressure in terms of getting more work done at a cheaper rate, but transformation deals are still there. So do you think those would make up for the margin pressure that the run side of the business would be under?
Yeah, maybe I'll take the first question and I'll ask Pratik to address the acquisitions and the margins as well, right? On the financial services, of course, some of the banks, they've all been in the news. Fortunately, we've had a very, very limited exposure to small banks or regional banks, so it has not had any impact on us. In fact, our own assessment is only about 1% of our revenue is where we have a little exposure to some banks, and that's probably the lowest in the industry. I do think banks, especially, insurance, especially in the financial services segment, they're under a lot more cost pressures due to the increase in inflation. And they're looking at how can providers like us bring a lot of efficiency into their operations, how can we bring more automation and other technology solutions. And being in the right place at the right time gives you the opportunities. And that's why we've done very well in financial services, and our outlook for financial services remains solid. Pratik?
Yeah, on the banking side, I'll just clarify in addition to what CVK already mentioned. First of all, our total composition from financial services is towards the lower end of what some of our peers have. Ours is about 20%, right? It was 19.9 or something like that. And within that, it is 1% of that. It's not 1% of the total company revenue. So it's like really minuscule in that sense. So that's on the clarification. On the margins, I think, I would not probably broad brush the run the business versus the discretionary. You are right. I mean, typically discretionary tends to give better margins, but we continue to have a good mix of the two. It's not as if like it's got completely lopsided. So beyond that, I don't think there's any much projections I would like to do. So I think we've given the margin guidance. It's a tight 1 percentage point guidance, and we expect to be well within that. Possible acquisitions, how can I tell you today, right? I mean, I don't want to repeat the word since you already mentioned. But, we'll tell you when we are near something. Before that, it's really premature. So, can't hear you.
Can't hear you.
Hello. Yeah. I have two questions. One is what led to the 140 basis points margin drop quarter on quarter. Can you please give a breakup on that? The second one is whether there's any target on attrition. How much lower can it go, since you haven't given any hiring target for FY24?
Answer the margin.
So the software seasonality impact itself is 125 basis points, right? And like I said before, the only way to look at software businesses is year-on-year comparison. You cannot do a sequential business comparison because there is a seasonality which is there for keeps. So, and that basically answers the reason for the change. Yeah, at a company level, it's year-on-year we are growing 20 basis points, 18.1 versus 17.9, and that growth is there in the software margins also, and ITBS has also grown. ERS, as we mentioned before, had a bad quarter.
Target on attrition?
I think attrition, I think we need to look at attrition in terms of what the trend line says. 2 quarters back, I think we reported 23.8% attrition. At that time, all the question was about will the attrition stabilize kind of thing. Now we are reporting 19.5% attrition. There's a significant drop in attrition. I also gave an indication about the quarterly attrition trend. AMJ 22, when we started the fiscal last year, the quarterly attrition what it was to what it is now, the drop is almost half of what it is. So the current quarterly annualized is almost half of what it is. If I were to use that as an indicator of how the attrition is going to be, I expect attrition to drop. What exactly is going to be the percentage drop? I think it's something which is going to be difficult to predict at this stage, but the trend line is positive.
I am Surbhi from the Economic Times. I just want to understand and maybe get more color from you, and if you could help me understand that, how do you see 23 panning out? Because the commentary has been very cautious from some of your peers, while HCL continues to see growth. What is your sense of how the demand is going to be in the coming year? What are the clients telling you? And what can we expect going forward in terms of the nature of the deals, as well as from where do you see, how do you see different markets performing in the coming year?
Yeah. So, Surabhi, in terms of FY24 outlook is really what is encapsulated in our guidance. So we've given a 6 to 8% guidance on the overall company, and 6.5 to 8.5 on the services side. Now, we have different service offerings. We have digital foundation, digital business, digital process operations, engineering and R&D services. We believe in all the four significant service offerings that we have. There are opportunities in efficiency and optimization, whether it is infrastructure, applications, even on the digital estate that clients have. There are opportunities to bring more efficiency even in the digital estate. Like there are clients, large clients, who are using 150 SaaS solutions. So there is opportunities to rationalize that and reduce the spend. So both in the legacy modernization or legacy operations and in the digital operations, we think there are lots of opportunities to help clients really manage the inflationary pressures on their business. That's one set. And of course, while customers have looked at what is ahead of them in this year, they have reduced some of the discretionary spend, because wherever they think it could be postponed, they have postponed. And to now execute on those programs, which are still important, they're looking at where can they take out cost so that whatever postponed programs, they can still continue. So there are large efficiency or cost takeout programs that we are seeing. There are several $500 million deals in our pipeline, and they will decide in the next maybe 3 to 4 months. And there is demand. The demand is a little more in Americas than in Europe. Europe also, I see the demand pick up a little bit as we get into the rest of the year.
Sure. One follow-up question I had for Sundar. Do you think that even in this kind of a demand environment, the 19% attrition mark is too high? How do you expect it to go from here?
So will the attrition moderate further from the current levels? The quarterly trends do certainly indicate that the attrition levels will further moderate. Is 19.5% attrition high in the current environment? We'll have to look at this as it's a 12-month basis, right? It's a trailing 12-month number. And we had AMJ and JAS both had very high attrition. So the annual number will not give a true picture. 19.5, can it be lower? It certainly is going to trend lower from here. Again, we need to look at where we stand with reference to where the industry is today. I think we are in a better position on a relative scale.
Yeah, if there are no more questions here, if there are 1 or 2 questions for the participants on the phone,
some people are joining us remotely. I'll pass it on to Devnita. Devnita, over to you.
Yeah, thank you. Good evening, everyone. Our first question is from Ronin, Hindu Business Line. Ronin, you unmuted your line. You may go ahead.
Sorry, we can't hear you.
We can't hear you.
Can you hear me now?
Yes, slightly better.
Yeah, hi. There has been a lot of questions on uncertainties and hiring. I just wanted to understand one thing on the hiring and the overseas markets, especially the developed countries like in Europe or in the US. What will be your hiring scenario in the current fiscal year?
I don't know if I got the question correctly. I think the question was about the hiring outlook.
Outlook both, in India as well as outside, Yeah.
Okay. I think the hiring outlook, both India and outside India, we still will continue to follow our strategy of new vistas in India. Our hiring plans will continue to focus on ramping up our new vista strategy. Outside of India, we'll again continue to focus on our nearshore strategy, and we will look to ramp up our nearshore. So our hiring plans will continue to follow the strategy that we are pursuing for the last 3 odd years. I think that trend will continue. I don't see we changing our strategy. Quarter on quarter, we'll obviously look at the numbers based on what headcount we have and what fulfillment requirements that we have. Quarter on quarter numbers will be planned on a rolling quarterly basis, but the overall strategy will continue to remain consistent.
Devnita, the next question.
Yeah. The second question is from Shovik Das from Mint. Shovik, please go ahead.
Hi, thanks, David. Hi, gentlemen. Just one quick question. So in terms of the verticals breakdown, spend.
Hello, I think Shavik just got dropped the audio. Hello. Devnita, can we move to the next participant in the while that Shavik joins back?
Shovik, you can speak now, yeah.
Yes, sorry, my mic got muted. So in terms of the verticals breakdown, the revenue-wise, I think telecom, technology services, and manufacturing were they registered the fastest growth here. So what I'm trying to understand is, are you seeing tech spends among clients in these sectors still remaining intact vis-a-vis the commentary that we've been hearing for the sector in general?
I think you're looking at the year-on-year numbers. So as you would recall, the first half of the last year was a very, very strong momentum. And in these two verticals, especially tech and telecom, the growth decelerated in the second half. So now we are really on a lower base. We need to see how to grow. I still think there is pressure in this segment, and there are some ramp downs, but there are also a lot of opportunities. So the timing of this will really determine how this two segments will pan out in this year. We think most of the pain is behind us, but the environment across the board has been very volatile, so we don't want to kind of give you a quarterly kind of view. We've given you an overall guidance, 6 to 8%. I think in the current environment and also on the basis of our bookings and pipeline, it's a pretty strong, very healthy growth rate, while maintaining or improving our profitability. So I'll leave it there.
Our next question is from Setu Raman from Reuters. Setu Raman, please go ahead.
Gentlemen, just wanted to understand, you mentioned ramp downs, some cancellations. So these are all like one-time ones, or the projects that were signed and then had to be cancelled? Like, did you see any cancellations in that sense? And also, you mentioned about deal delays. So is this closing the deal is being delayed? Could you please give more color on that, as well as how long do you think it's going to take for a recovery in the market? Thank you so much.
Yeah, as I mentioned, in tech, there has been pressure. We think a lot of it is behind us, but there may be a little more pressure because as I mentioned, the environment or Some of these decisions are a little bit more volatile. When customers plan their spend for FY23, they had certain goals. So some of that is reflected in the ramp downs that has already happened. We believe they have a fairly stable annual budget, and most of the ramp downs, what was planned, is already happened. That's what we've assumed. And what is this other question? Okay, thank you.
Devnita, any more questions?
Yeah, just a couple of more questions. First one is from Devangana from Money Control. Devangana, you can speak now.
Hi, am I audible?
Yes.
Yeah, so my question to you is your peers have been talking a lot about exploring chat GPT and generative AI with clients, and clients have been, TCS said that the conversation starts and stops at generative AI from clients. So wanted to understand, how is HCL Tech looking at it? Are you coming across similar conversations with clients?
Yeah, I think it's not any different. In fact, most conversations are happening in chat GPT almost, right? People are not talking to each other, but they're trying to talk to the chat GPT more than anything else. So that's one. I think it's we believe as an organization, generative AI is one of the biggest opportunities where we need to find the most impactful use cases, both in technology, which is either operations or software development, and in a lot of our business use cases for our clients in different verticals. So we have teams across the board working on building those good proof points and use cases, and then we are going to benchmark that with respect to the impact it can create and really double down on the high impact use cases. I think it's a very, very strong opportunity. More than the technology, a lot of opportunities are there on how the technology can be applied in a real business context, and that's what we are very, very excited about.
Last question for the day is from Romita. Romita, unmuting your line, please go ahead.
Am I audible?
Romita, you'll have to be a little louder. Romita?
Hello? Is this better?
Slightly better.
Yeah, so I just want to understand one thing based on your margin guidance, which felt a little conservative given the kind of performance that you have given. So I want to understand, has the current demand environment translated to a strong pricing environment as well across projects, and do you see enough of possibilities to improve pricing across projects through the year, given the current cautious environment that we see?
Yeah, I think this is not an environment that is conducive for price increases. There has been some instances where customers have asked for reduction in price. Obviously, more than reduction in price, expecting us to deliver the same outcome at a lower cost, whereby they give us some flexibility on how we can deliver. So like if the work has been done in a certain location, can we do it in another location which is a little more cost effective? So those type of conversations are happening, and there are some instances where there is reductions as well. So we don't expect a lot of price increases to happen. I think that was mostly feasible last year. I don't think it's feasible now. We think the pricing environment will be stable, and that's what is advising our 18 to 19% guidance. So thank you, and with that, thank you for joining us today, and look forward to seeing you during the next quarter. Thank you, everyone.
Thank you.
Thank you.
साकेत, भारत का दूसरा फ्लैगशिप, एप्पल का फ्लैगशिप स्टोर जिसका भी कुछ मिनटों पहले ही टिम कुक